Somebody making $80,000 a year and somebody making $800,000 can pay the exact same tax rate.
Sometimes the person making less pays more. That's not a typo. It's not a glitch in the system.
It's because the wealthy use 6 legal strategies almost nobody teaches you in school. By the end of this video, you'll know all 6 and how to start using them this year.
Here's the thing most people get wrong about taxes. They think the tax code is designed to punish you, but it's actually a series of incentives.
It's actually designed to reward specific behaviors. Saving, investing, building a business, buying property.
Stick around for loophole number 5 because it's the only account in the entire tax code that gives you 3 tax breaks at once.
Here's something most people don't know. When you put money into a traditional retirement account, a 401k in the US, an RRSP in Canada,
Pension in the UK, or superannuation in Australia, you're not avoiding tax. You're delaying it and shifting it to a year when you'll likely pay less.
Think about it like this. Imagine you're handed 2 envelopes. One says pay tax now, while you're earning your highest salary of your life. The other says pay tax later, in retirement, when your income and your tax rate will likely be much lower. Which envelope would you choose?
That's exactly what high earners do. They max out these accounts every year, not because they're rich, but because doing this is part of how they become rich.
But here's the surprising part. There's a second version of this trick even fewer people use. That's loophole 1.
But loophole 2 is where things get really interesting, because it involves something you can literally live inside of. That sounds almost too good to be true. A property can go up in value every single year, while the owner still gets to claim its losing value, on paper, for tax purposes. Here's a simple way to picture it. Imagine a coffee machine at an office. Nobody expects it to last forever. Over 5 years, it slowly breaks down and needs replacing. The tax code lets a business deduct that decline in value every year. Real estate works the same way, just on a much bigger scale and over a much longer time.
Imagine 2 people sell the exact same investment for the exact same profit. The only difference between them? How long they held on to it before selling.
This next mistake is one of the most expensive ones people make without realizing it. Selling an investment 1 or 2 weeks before hitting that 12-month mark. Now, what happens when an investment doesn't go up? It goes down. Turns out, even a losing investment can still work in your favor. That's next.
This one sounds backwards the first time you hear it. Losing money on an investment can actually save you money. It's called tax loss harvesting.
If someone sells an investment for less than they paid, they can use that loss to cancel out gains from other investments that did well. Picture a portfolio like a scoreboard. If one stock is up $10,000 and another is down $4,000, a wealthy investor might sell the losing stock on purpose.
Before the year ends, so their taxable gain drops to $6,000 instead of $10,000. The loss doesn't just sit there being sad, it becomes a tool.
Here's the surprising part. Some investors do this every single year, on purpose, even when their portfolio is doing great. There's an important rule to know here, Most countries have some version of a wash sale rule. This rule stops you from selling at a loss and immediately buying it back. If someone offered you an account where money goes in tax-free, grows tax-free, and comes out tax-free, would you use it? In the US, that account exists.
Here's why it's so powerful. Contributions reduce taxable income going in. The money grows through investments without being taxed along the way.
And when it's used for qualifying medical expenses, withdrawals aren't taxed either. Most people don't know this part. An HSA doesn't have to be spent right away.
Money can be invested and left to grow for years, even decades. Canada, the UK, and Australia each have comparable health-related accounts with their own tax advantages.
Now for the last loophole, and it's the one that small business owners overlook the most, even though it could be sitting right in their own living room.
Here's a question. If someone runs even a small side business from their home, could part of their rent, internet bill, and electricity bill legally reduce their taxes? Yes.
Think of it like drawing an invisible line around one room of the house and saying, "This space earns me money."
The tax code allows a fair portion of the costs of running that space to be treated as a business expense, not personal spending. But here's the surprising part. This isn't just about home offices. Business structures themselves.
Setting up a proper company or corporation instead of operating as an individual often unlock lower tax rates and additional deductions. Notice something about all 6 of these. Not one of them is a secret trick or a shady workaround. Every single one rewards a specific behavior: saving early, investing patiently,
Owning productive assets, and planning ahead instead of reacting in the moment. The wealthy don't have a different tax code.
They just use more of the one that already exists. The same one available to everyone watching this right now.
If this video gave you even one idea you didn't have before, that's the whole point. Drop a comment and let me know which loophole surprised you the most.
And if you found this useful, hit subscribe, because next week's video is about the biggest tax mistake first-time investors make. 6 strategies.
0 shortcuts. Talk to a professional in your country before acting on any of this, but now you know exactly what questions to ask them. I'll see you in the next one.